Good afternoon, everyone. Thanks so much for your patience and welcome to another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And today, in David's absence, we have invited the eyes and the ears of our trading desk onto this call. So joining us today is Diana Avador, our fierce head of trading at Barometer, joined as well by Jim Shitakis, one of your portfolio managers. On today's call, we are going to provide a brief macro overview. Diana is going to walk you through what she is seeing on the trading desk. And of course, Jim will be commenting with color as he sees with respect to sector allocation and where the market's moving. So with that, I will turn the conversation over to Jim and Diana. And I would like to remind everyone that if you have some questions, don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Zoom link via the Q&A or the chat. So with that, I turn the conversation on this very sunny but chilly day in Toronto. Diana and Jim, welcome to our program. We're so thrilled to have you today speaking to our investors, and look forward to your feedback and color and what you're seeing. Thanks so much for joining us.
Pamela, thank you very much for having us and for introducing us like that. Fierce. It's been a fierce market for sure. Thanks everyone for joining us. My role at Barometer is to watch what's going on in real time on a day-to-day basis. And certainly 2022 has been an incredible year from a volatility perspective. We've had a year like this hasn't been around for quite a long time. Dave in his previous webcasts have always mentioned that we've probably seen generational lows in rates. And so of course, that actually came true, and we've had one of the most hawkish and the fastest tightening central bank regimen globally. Which has created a situation of intense volatility because it came at a time that growth was very strong coming out of the COVID pandemic, which granted volatility happened then as well. But what we've seen this year on trading, on the intraday volatility has been quite high, and I'll show you some of the things that we've seen. From a trading perspective, it's always about what the market prices in. When you look to manage a portfolio or when you think of what to invest in, you always tend to think to yourself what you think is going to happen going forward. But here, in trying to assess what's going on in the market, we always talk in terms of what's priced in. So let's say in the beginning of the year, only growth was being priced in as it was coming out of COVID. And then we were getting these supply chain bottlenecks, which we decided that they resulted from big demand, and to a certain extent they did, but some of them were COVID closures, so they were hard to unbottleneck, so to speak. And then came the rate hikes. The central banks were caught flat-footed into a big inflation number, and they had to catch up very, very fast. In the beginning of the year, economic data was coming in very strong, and that was good news equals bad news, because that meant that central banks had to tighten faster. As we progress through the year, and what we've been seeing now is good news has actually become good news again, in the sense that after such a tightening period, the market and the economic data has not fallen off a cliff, because of course everybody is fearful of inflation, recession. And while a recession may occur, everybody allows for that to happen. The question now has become recession, yes, but is it a normal recession? Is it a deep recession, short or long? Short, normal is good, long, deep is not good. So from the economic numbers that we've seen recently, the numbers have come in pretty good. And so that makes us happy. And some market participants feel that, and you've seen it in the market in the last couple of weeks, it's actually taken the news well. So let's just begin with some pictures that I've wanted to show to you. So 2022, very, very highly volatile year. The number of months with the S&P up or down 7.5%, at least 5. We've had 5 months this year. We're on month 11. At least one every other month, we had a 7.5% move in the market, up or down. That is, you see in the chart, it hasn't happened, doesn't happen very often. Last time it was like 2010. This is where we are. And of course, in the 1930s and 40s, very much. But it has been an extremely volatile year and with lots of rotation. So if you made up your mind in January where you were going to invest, because you thought that looked good, by February, the market told you that that's not right. Rotate your portfolio only to be proven differently the month after. So it's been a bit of a yo-yo up and down. Because of this, sentiment has, and together with the big rate hikes, which really hurt the pockets of many people in terms of their mortgage rates and food inflation and everything else, energy, any kind of commodity, your utility bills have, your Enbridge gas bill has probably doubled in this period. People have, sentiment has become very depressed, and quite rare for sentiment to be this depressed for this long. This is 7 weeks in a row. And this is a phenomenon that happens every once in a while, but this is data, this is sentiment data since 2002. Every once in a while we get like this, but it hasn't been this low for this long in a very, very long time. So what's priced in from a sentiment perspective, when we see sentiment like this, we want to see where people put their money. It's one thing to feel bad, but then what are people doing with their money for real? And in the beginning of the year, people felt bad, but money has not really started flowing out of the market yet. And now, however, some portfolios are very, very lean and cash levels are pretty high. So again, going back to what the market's pricing in, the market has now priced this in. So it's no surprise to anyone that sentiment is low, that inflation is being fought, and that central banks are raising rates in a very aggressive manner. The question is now, and what traders are watching for, is a pivot. Now, what's a pivot? A pivot, does a pivot mean that we're going to cut rates? No. Does a pivot mean that we're going to stop raising rates, or that the central banks are going to stop raising rates? No. The pivot at this point, interestingly enough, just means, are they going to go down from 75 beeps to 50? Bank of Canada last interest rate hike actually surprised and only raised 50 beeps instead of 75 beeps. If you scratch your head when you see the headline in the newspaper, market rallies, central bank raises 50 beeps, you go, wow, but that's supposed to be bad for the market. But again, more was priced in, so the market reacted favorably to a 50 beep rate hike. And that is what the pivot is when we start going a little slower. The market has been very selective and rotational. You recall in years past or months past, where technology was the darling of the market, the earnings season has not been very nice to the big mega tech companies. This is a chart of mega cap tech relative to NASDAQ. So all the other names in the index, and it's been abysmal. Facebook, which is now Meta, was down 20% after their earnings. Google, same. Only Apple's holding up somewhat well. So previous darlings are no longer darlings, and money has rotated elsewhere. So where has it rotated? Well, it rotated to the commodity markets, but that has been volatile as well. So this is energy relative to technology. And over the last 5 years, technology is now sold off, and energy has rallied to catch up over 5 years in performance. So it's been, you really had to shift gears in your portfolio to not get hurt. And, maybe 2022 is about what you don't own rather than what you do own, so that you can keep the powder dry for when things get better, and the market has already started acting a little bit better. We'll see if it holds. Asset returns have, of course, been in energy, mostly other commodities, and the worst sector to the right has been telecom, technology, discretionary. Those have been the asset returns so far, very much mirroring the 1970s. But the 1970s have actually been quite good to asset classes in the latter half of the decade. You know, all asset classes have actually done pretty well in the latter part of that decade. So it's not bad. We might have a few years ahead of us where commodity cycle, and Dave has spoken about this before, that the commodity cycle may begin again for many reasons that we can go into a little later. Our portfolios, this is our portfolio exposures. I've used the exposures that some of you that were on the call last week may have seen. We haven't made any changes in the last week so much. We're still overweight energy, financials, and discretionary, not discretionary, industrials mainly. But you see the third line there is government bonds. That's actually cash and cash equivalents, 30, 60, 90-day bills. We do have a lot of cash in our portfolios. And there hasn't been, we didn't feel that we had to invest it. It can go slowly and the market can show us the way, what outperforms or relative strength or what holds up. Because in this kind of volatile environment, you don't know whether next month is going to be down 7.5%. Flows have been negative, not in the beginning of the year, but certainly have gotten worse in the last 3 months. Global risk assets have lost 35 billion since the November 21 peak. So again, when we go back into what the market's pricing in, the market's pricing in negative outflows from equity markets before they did not. So we have sentiment low, we have flows have been quite negative and have now accumulated. There also hasn't been any diversification that you could have had. The bonds as an asset class have also lost. So you had to be very surgical in your exposure. So cash was good. We've had the longest outflow episode from gold since 2013-14. This is primarily the fault of the dollar. The mighty dollar has rallied big time. And so actually the bull case for commodities is even more because they've held up so well in the face of a rallying dollar. So they're priced in dollars, so they would be selling off, and they didn't. The strength has come from their own merit, despite the big rally in the dollar. But gold hasn't fared that well. Europe, a mess. We unfortunately experiencing, watching a war going on, a commodity crunch, an energy crunch for Europe. It'll be a tough winter, and European equities have seen 38 weeks of outflows, matching 2016. So until we see what's happening there, and they're tightening into what's probably already a recession. So the outflows there have been big and long and related to many geopolitical as well as economic reasons. The previous horsemen are tired. I've discussed that technology has been not so good, and that 2022 from a trading investment year has been about what you're not invested in. And this is previous years been fantastic. If you're still in technology, this hasn't worked for you this year, and certainly hasn't worked this earnings season. So the silver lining is that the FANG, as they used to call it, and they still call it, as a percentage of total S&P is now coming down, allowing for the index to be a little bit more diversified as other sectors are rotating in value and increasing in value within it. So what worked? Where's the strength? The strength has been in energy, healthcare, industrials, and certainly real estate and technology has taken it on the chin. Our portfolios, we've tried to steer away from, this is where we've tried to steer away from, and that's why our main exposures are in energy, industrials, and we have some defense, energy, and we do mind the dividend payout and share buybacks. The whole energy sector has sort of shifted as governments have not been that friendly to the energy companies for environmental reasons. Policies are not supportive, and so the companies have really not invested so much in capex and in drilling and exploration. Because if you were a CEO of an energy company and you don't know what ruling or what government policy is going to hurt you next year, you're going to hold back from investing. But what that led to is these energy companies having so much cash on their balance sheets that they're selling down debt. They're first time that I've seen they're doing big buybacks and paying out dividends. So maybe the energy companies of tomorrow are going to become what the staple and discretionary companies, the large ones like Procter and Gamble and so forth have been in the past, where now they've become these large companies with huge free cash flows that are giving you great dividends, paying down debt, leverage is going down, and just becoming a safer, less volatile sector. What about earnings? We're watching the earnings. Again, what's been priced in. So before the earnings season, consensus revisions to the EPS have been coming down. Analysts and companies telling analysts what to think. They've taken earnings estimates down as rates go up and growth might be moderating. And so the earnings season has been okay, with the exception of the tech sector. And we always watch as how the stocks trade into the earnings. That sector has not traded so well into the earnings, and then we found out why, because they missed earnings. But consensus revisions have been coming down, with the exception of the energy sector, which have been going up because it's been not a darling for so long, and now they're starting to throw off all this cash. So earnings estimates have gone up, and earnings expectations have come down for all the other sectors. The results have been, and Jim can talk to that, to earnings maybe later, but the earnings results this quarter have come in okay relative to subdued expectations. So markets taking it in stride, and we've had a few good days, couple of decent weeks in the last couple of weeks throughout the earnings. So going forward, we expect U.S. headline inflation to slow into 23. We're watching for the Fed to pivot. And again, like I said, pivot is, 50 beeps to stop this 75 beep every month, and to kind of moderate the rate hikes and smooth it out a little bit. So we can, and that's what's the market's pricing in, what the terminal rate is going to be. And I'm happy to answer any questions, trading, or give it over to Jim if you want to talk a little bit about our portfolios, or if you guys have any trading or exposure questions that you might have.
Yeah,
Thanks.
sure. Jim, why don't you carry it from here? And then Diana, I have a handful of questions that I can ask you afterwards.
Excellent.
Sounds
Perfect.
good. Thanks, Diana. Thanks, Pamela. Thank you to everyone for joining. And Diana, that was a nice synopsis of what's been going on. I'm not sure I have a whole lot to add, but I just want to touch on four things, and some of them Diana touched on as well, but just to emphasize. So the economic data has been coming in. It's been skewing a little bit better than, a little bit stronger than expectations. And that's in employment's been a little bit better than feared. The CPI numbers, the Consumer Price Index, has been a little bit better. Growth has been a little bit better. So overall, the U.S. economy is doing better than one would have thought, given the rate increases that we've significant interest rate increases that we've seen. And you always wonder, why is that the case? And part of the explanation is that the US economy is 70% consumer, and consumer balance sheets are strong. Their bank balances are still pretty close to the COVID highs. There's been some drawdowns, and we know that from the bank conference calls. So consumers have money, they're working, employment is still tight, so they're spending. And the Fed is finding it more difficult to slow the economy down, but it is slowing. The pace of growth is slowing, so there's steps in the right direction. And then Dan touched on earnings. Again, this is earnings are better than feared. Initially, going into this quarterly earnings cycle, companies reported their third quarter earnings, and there was apprehension that there might be some negative surprises, and there were, mostly in the technology sector, but for the most part, they're better than feared. We had 11% revenue growth and 3 or 4% earnings growth. So margins are getting squeezed because labor costs are higher, supply chain issues are still persisting. So there's still some give and take there. So what have we been doing? As you've seen by our exposures, we have significant weights in energy, and both in Canada and the U.S. Valuations are still compelling. The companies are experiencing significant positive cash flows from the elevated energy prices. It's been a virtuous cycle for them. And just as an example, we're looking at this the other day, that Exxon, you guys may have heard of Exxon, a fairly large U.S. Integrated oil company with operations throughout the world. They year to date, they've almost doubled in value. So that's it's incredible for a company that big in that sleepy an industry to double. It's really been quite remarkable. The other areas that we've been focused on are industrials, and within industrials, it's aerospace defense. And it's the defense sector that's really performed very well. Think of Northrop Grumman, Lockheed Martin, General Dynamics. Northrop Grumman makes the B-2 bomber. They're the lead contractor on the B-2 bomber, and supply drones for fighting hot wars. Lockheed Martin is the lead contractor on the F-35, and every country in Europe is scrambling to make new orders of the F-35. I think even Canada ordered between 50 and 100 jets, and they are $100 million each. So there's a lot of, they have significant backlog, let's put it this way. So I think we're in the areas that have been moving in the right direction, or in positive relative strength. Healthcare has been another area of focus. They had a bit of a hiccup earlier when there was some belief that there might be drug price reform, and there was somewhat, but again, it was way better than feared. So some modest curtailment to pricing action, but some of the companies that we're invested in have had significant breakthrough drugs. One that comes to mind is Eli Lilly with their diabetes and obesity drug that's potentially going to be a $20 to $30 billion franchise for them, and they're not getting any credit for a drug that they have in development for Alzheimer's, and the readout will be early next year, and we think that could be a fairly large market as well. So there's a lot of interesting companies to invest in the U.S. We're really quite happy with our portfolio. Then finally, I just wanted to touch quickly on this thing that's going on south of the border. There's an election going on, midterm election. It certainly appears that we're going to get one or both houses of Congress moving to the Republican side, so that yields a divided government, and historically that divided government is good for the markets, because you can't really do a whole lot of damage unless it's a bipartisan nature. So that's an encouraging sign and we'll be watching that throughout the evening and in the early hours. Just a note of caution: it might take a few days to really figure out who has won what and what the final tallies are, just because there's so many very, very close races, and it's too difficult to call. So I think that's all that I had. Pam, take it away.
Yeah, so thanks so much, Jim and Diana, who everyone, I don't know if you're aware, but in addition to David being on BNN, Diana is frequently on BNN. She provides a lot of insight on a generally a weekly basis at the close. So if you tune into BNN, you can catch Diana in that capacity as well. We're lucky to have both Jim and Diana on the desk. With that, I have a couple of questions. So the first question for Diana is how Barometer approaches its hedging. So specifically, we have an investor that watches us, Bob, every week. And Bob is curious how we're currently approaching our US hedges. So if you could comment on that, Diana, I know Bob and all of our viewers would be appreciative.
Thank you, Pamela. I think I'm going to give the hedging question over to Jim.
Sounds good.
Well, thanks, Di. I really appreciate that.
We ebb and flow. We ebb and flow on the hedging side, but there is a process to our madness.
Yes, definitely. So we've been watching as the U.S. dollar was gaining strength. We wanted to maintain exposure to the U.S. dollar, so we were unhedged. As we've seen in the last, week and a half, well, it's probably more than that. It's probably 2 weeks. The U.S. dollar is starting to peak and lose strength, especially against Canada. We've started to put our hedges back on, and so we went to 50%, and now we're at 100% hedged. So it's an iterative process that we use to look at what the value of the U.S. currency is relative to Canada, and to take the exposure up or down according to that.
Thanks so much, Jim. The next question is about gold. Specifically, how does gold look from a technical standpoint these days, guys? And what gold stocks would you put on the radar if you had to choose a couple?
So, technically gold actually is trying to do its best. It and materials are starting to look not bad. However, it is affected by a lot of external things. It really is a proxy on the currency. So you want to have a view on currency when you invest in gold. And lately has been a really big correlation with Bitcoin, actually, or crypto market, as some of the flows that affect gold market flowing back and forth from the cryptocurrency market. And, we had a very strong day today for gold, for example, but Bitcoin's down 12%. It's interesting because gold hasn't done as well as you would have expected, given the huge inflation number headlines that we've seen this year. With inflation numbers at 8-9%, you would have thought that gold would have been the only asset out there that would be doing well. Instead, it languished in the beginning of the year, and it's now starting to look a little better. In terms of the earnings that have come out, I think that the earnings have been softer than you would have wanted them. And of course, it's not going to matter if gold actually continues to rally because of some structural problem with the crypto market, like what we've seen today, and or a US dollar volatility. So I think that gold, and then the reason why we don't have so much in the portfolio is because it does have a lot of external influences that don't necessarily just allow you to look at gold in singularity. From a trading perspective, it's a tiny market with a small amount of participants, and it can really, from a stock perspective, from an S&P exposure, of course, CSX is a little more, and it's highly dominated also by central banks. So you never know what the central banks are going to do. We now know in hindsight that they've been accumulating gold, probably as a result of what's been going on with Russia, Ukraine, and China, where China is in this whole conflict back and forth. So there's been some accumulation of gold by the central banks. But of course, you don't know those flows, and they're generally not because of gold fundamentals, but rather some kind of hedging program. And like I said, closely related to crypto and currency. It really is a currency.
Thank you so much, Diana and Jim. So that concludes the questions we've received this afternoon. So with that, we appreciate you both coming on. And actually, I think our viewers, the comments that are coming in, very positive. They'd like to see more of you. So we don't want you to be shy. We want to see more of you guys. And I'll speak with David and get you as more regularly on this program. We appreciate your time. And if you have any questions that weren't answered today, don't hesitate to reach out. My email is phastings@barometercapital.ca. And of course, we're always happy to speak with our investors or any prospects that are looking to come and join the Barometer family. With that, we'll see you the same time, same place next week. I'm looking forward to it. Thanks, Diana. Thanks, Jim.
Thanks, everyone.